Welcome, this is Richard, and we're going to take a look at the dividend stocks today, the wonderful world of dividends. Dividends can play a very important role in your portfolio. Obviously, not all dividend stocks are created equal, and like everything else in Wall Street, you have to do your homework. Now, it's made a little more complicated because of the narrative that Wall Street uses in defining the dividend payout ratio. We'll take a look at this here, the dividend payout ratio. You can look it up anywhere. And they're saying understanding the payout ratio. The payout ratio indicates the suitability of a company's dividend payment program. No, it really doesn't, because the problem is the formula that they use. They have total dividends divided by net income. Net income has nothing to do with dividends. Dividends are paid out of the cash flow statement. The cash flow statement, after all expenses, has residual income, what analysts call today free cash. Dividends are paid out of free cash. And if you don't have the free cash to pay the dividend, one, you can reduce the dividend, which will never happen. Rarely does that happen. Two, borrow money to make up the difference and pay the dividend. Third, sell stock to make up the difference and pay the dividend. Now, this kind of produces the good ones and the bad ones. We're going to take a look at both. I'll give you a few ideas of the bad ones. Now, here's Dow Chemical, a very well-known company, and paying a 6% dividend. Now, this is a pretty recent filing, and you can see they have not had the free cash to pay the dividend. Now, they're going to have to borrow money or sell stock to make up the difference. Here, this delta is even bigger. They're going to have to borrow money or sell stock to make up the difference. So this happens. A couple more we'll take a look at. Here is NL Industries. Now, these guys, again, according to Wall Street definition, as long as they're making money, you have nothing to worry about. But here, this another 6% dividend. And now we're short this stock, but we're short because the owner's earnings are big negative, not because of this dividend. But here, again, they're going to have to borrow money or sell the stock to make up the difference. So another, and this is for all my friends in Oklahoma, this OG&E, everybody in Oklahoma owns this thing. But again, positive earnings, according to Wall Street, should be no problem. But here, remember number one, they could cut the dividend. Companies, especially these utilities, will never cut the dividend. It's blatant. They have no intention to cut the dividend. Their stock could be cut in half. So they have to sell stock or borrow money, sell stock, borrow money, and all of this is not good. You're getting diluted. This is not good if you're a shareholder. So now this happens to some of the bigger stocks as well. Now here's Coca-Cola, and again, they're not bringing shareholder value. They're shareholders right now. That's why we rate it as a speculative stock. But here again, they're having to make up the difference here. They're going to have to make up the difference here. So this happens more than you think. And one of the things that I like to do is we have a section in the website that I keep a watch list or some of the stocks I buy and sell. But here's a dividend ETF. Now, people buy this for the dividend yield. Now, I can sort and filter across all these different metrics, but I'm looking at free cash. Anything above 1 is good. Now, as I come down here, there's 84, 85 stocks in this portfolio, and 55 have free cash to pay the dividend. The rest here do not have, so 84, so that's 35% of a dividend paying ETF. 35% of the stocks in that ETF do not have the free cash to pay the dividend. They will be selling stock or borrowing money to pay the dividend. So this is a lot more common than you might suspect. Now, on our website, we have a dividend section, and the stocks on this section have a dividend yield of at least 5% and has a free cash payout ratio above 1. So the dividends are secure here, and there's a way to monitor this using our website. And of course, now one stock that we'll take a look at here is Plains Petroleum. Now they're paying this is a huge dividend, and they in fact have the free cash to pay the dividend. This is exactly what we're looking for. Now, also on any dividend paying company, I have to have a growth component to that company. And here they have an owner's earnings of close to 14%. And when I look at QE coming, if they're looking for growth, surely that's good for energy. AI, that's good for energy. Say if you go into a recession, then I think the music will slow up a bit, but it's not going to stop. And meanwhile, they're paying me a very nice dividend here. Now, one of the things I always like to do is go over to AI and ask this question here we go. For this company, what is the exact dilution to shareholders compared to its peers over the last 5 years from the latest 10K and 10Q filings? Well, sure enough, here they come. And their conclusion, they give me a conclusion here. But the next question is even better. What is the net dilution after buybacks? And what I find out here is that, I guess 5 years ago, it's 705, and they bought 40 million over this period of time. Now it's only 665. So they've actually helped. There's no dilution here. It's just the opposite. That this management team, it says it best here, this management team has a very strong shareholder value, that I'm not getting diluted. So I like this management team. I think they'll be able to handle things going forward, and certainly I'm not going to get diluted. Now, in today's world, there's information everywhere. When I first started, there was no information anywhere. And now it's hard to prioritize which information is most important or important. And it kind of leads you to the question, do I have a problem with my dividend stocks or not? And this is kind of an awkward conversation. If a person doesn't think they have a problem, they're not going to listen. I hope you're listening to this video, because if you have a problem, you have a dividend stock and they don't have free cash to pay the dividend, you do have a problem, and that you need to fix, because I don't think it will get any better going forward. And which brings me to a question everyone should ask. Who do you trust? When the chips are down, when you have to make a good decision, where do you go? What do you do? Who do you trust? Now, you'd be surprised how many answers I get with that question, from brother-in-law to neighbor but I'm not asking you to trust me. I am asking you to trust our website. Our website is relevant and reliable. The numbers come from the 10K, 10Q. This is factual information. Now, a chief financial officer, because of GAAP accounting, on the income statement, even on these filings, he can come up with any number he likes that fits him best. Now, he cannot do that on the cash flow statement. There's not any manipulation. If there is, the CFO is in big trouble. So when it comes to relying on making a hard decision, the reality of things, the reality against the story, rely on our website. I think it can help you. So that's it for me today. I hope this helps. I think we can help you grow and protect your wealth. And remember, buy the good ones. Thanks.